Hi, Dominique. Great to see you. Welcome again to a week ahead, and obviously a lot going on in the markets in the past week. I don't want to say unprecedented type moves, but certainly, once in kind of 10 years type stuff. So, I guess the two big things over the past week has been kind of FOMC and payroll. So, what was your take on it? Anything stood out? And is the market seeing any of this wrong?
So quickly on the FOMC, they pushed back against 75 basis points as I expected.
Exactly what you said.
Yeah, basically they are sticking to their original plan, which was to really re-examine the pace of tightening in September. So they are going to do 50 both in June and July. And they said that, meaning Chair Powell said that this is based on inflation flattening out, which I don't think is a very difficult test to meet because inflation is already so high. So basically, even though inflation is at 8.5%, if you use the CPI, the Fed is sticking to its original plan of waiting until H2 to see what's happening to inflation. And the risk is, of course, that if there is no change in the momentum of inflation, as I expect, they will just fall further behind the curve. But there we are.
Yeah. And quickly on the comments on QT, it was pretty much what you had expected.
Very much so, yeah. I mean, all the market attention was on the Fed funds. And in terms of market reaction, yeah, I mean, the least you can say is that the market doesn't have a great deal of confidence in either the Fed capacity to bring down inflation, because we saw the curve steepen, we saw long-term break-even move further away, and we saw move down in my measure of long-term Fed funds, for instance, the 18-month, 1 month OIS forward swap. So there is that. And then I guess the market doesn't believe the Fed can engineer a soft landing either. So for once, I completely agree with the market. The Fed is going to fall further behind the curve, and that will make the employment cost of bringing down inflation that much higher.
Right. Okay. And then quickly on payrolls.
So on payrolls, there was a bit of a upside surprise, as I thought. The momentum is stable, and I am starting to suspect that the US economy is getting a second wind from household borrowing, because what we got on Friday, and which didn't get a lot of attention, but I think at this stage is actually really important, is a non-mortgage household credit. And it was twice as high as expected. So households have a lot of capacity to borrow because they've been basically deleveraging since the GFC.
Yeah, this is something I think we've been talking about, I'm going to say a couple of weeks in a row, and I keep asking you the same question, is a jump in, say, credit card debt or just non-mortgage borrowing. Is that sign that people are falling further behind because their wages are not keeping up with inflation, or is it they feel good and they feel confident about their finances, over the next kind of 6 to 12, 18 months, so they feel comfortable taking on more credit card debt?
So I'd say it's more the latter, and another factor, which is banks are desperate to find ways to deploy their liquidity. They are sending ads for credit cards. My two kids tell me that they get ads through the mail every day from banks begging them to take on credit cards. So, and interest rates are so low in real terms. I mean, okay, the 30-year mortgage 5%, but still negative in real terms. So yeah, so this thing is going to make, this thing first shows how far the Fed is behind the curve, that it's let things get out of control, and it's going to make it that much harder to stabilize the economy and bring down inflation.
Right. So I think something for investors should think about is, especially kind of from a European perspective, everyone's concerned about stagflation, but your view on the U.S. economy is that the economy is probably better than a lot of economists think. And yes, we have high inflation, but also the economy itself is in fairly decent shape, or probably better than people. So you're not really in the stagflation camp. We may be heading there. And that's also one of the reasons why you would like the Fed to be moving faster than they are.
Oh, definitely. I mean, there is clear evidence from past cycles. The more you wait, the more you hurt the economy. And sure, I mean, what is stagflation? Negative growth and inflation. We're not at negative growth yet, but the thing is, to kill inflation, the Fed is going to have to bring growth in negative territory. So stagflation is probably next year, and it could be really nasty. I mean, when we had the discussion, the webinar on my call, someone raised the issue of, what happens to fiscal policy if interest rate goes that much higher. Obviously, fiscal policy will be on an unsustainable path, and that will force the government to implement a much tighter fiscal policy when the economy will be slowing. So this is not going to get resolved painlessly.
Yep. Okay. All right. And on that positive note, I mean, listen, you've been consistent. You've been totally right on all these things, and they're continuing to play out. Let's see. Obviously, but in reality, the employment number, at least let's just say wages, wage growth was not wage growth, but wage prices was actually a bit more tepid than the market assumed. And I wonder, how important is this CPI number moving to next week?
So not very important, because the Fed is on automatic pilot. The one thing the Fed hates more than high inflation is being proven wrong. So they are going to cling to their plan and claim success until evidence to the contrary is so overwhelming that it can no longer be ignored. So no matter, unless we have a really shocker like say core CPI going to, I don't know, 0.7. They are going to stick to the plan. But in terms of where the economy is headed, you don't want to look at just one number, especially since we are in a period of transition where before Ukraine and before the resurgence of COVID in China, actually supply chains were improving. So I think we are getting the lagged effect of that, and we haven't yet gotten the full impact of the renewed lockdown in China and of Ukraine.
Yeah. So one last thing I was going to ask is, a strong dollar, can that help bring down inflation?
Oh, definitely.
Yeah.
But the question is, will we get there? As Bilal has explained to us many times, global central banks tend to lag the US. So the dollar appreciation is at the beginning of the cycle.
Yeah,
when
I know.
He says, "Oh my God, I'm behind the curve," and then they all try to catch up to the
and then the dollar strength slowly abates.
Yeah.
Okay, so on the CPI number, what do you expect, and are there underlying components of it that people should be focused on?
So in a way, it's not so much the CPI. So the consensus is 0.4 for core, which seems reasonable. As always, I will be looking to the median price and the trim mean CPI, because it gives a better indication of trend.
I know.
And I expect those to go up a bit. But it's a Fed reaction to the CPI, what they call it, because they've said, inflation will have to, or they've said, Powell said inflation will have to flatten. But I'm expecting inflation to flatten. But what does that mean? At what level is 0.4 an acceptable level of inflation, of monthly inflation for the Fed? I hope not. But so we need to pay attention to how they characterize the CPI more than to the level of the CPI.
Now, what are you expecting for the trim mean?
I think so we've had a stabilization for the trim mean for a month, which I think was a bit of a fluke. Also, that data tends to get heavily revised, so I think it could it's likely to go up from relative to last month.
Okay, and then any important, I guess, speeches? I think you're mentioning that several of Fed speakers, I guess, will be speaking the day before CPI. I don't know if there's the impression that they'll see it a day ahead of time and that will affect what they say, or just generally they'll talk about the general path the Fed's on.
I'm hoping that they can be drawn to say something specific, because central bankers don't like to be pinned down, so they like to speak in vague and general terms. So I'm hoping there will be an aggressive person out there who will push them to say whether they think 0.4% is acceptable or not.
Right. Okay, cool. Anything else that investors should be thinking about, focused on?
Just keep an eye on the University of Michigan consumer confidence, because the last number had a sizable positive surprise. It was not confirmed by the conference board consumer confidence index. Those two indexes tend to track each other, so I'm expecting that we could have a negative surprise in the Michigan index, or that it could go back to a very weak trend.
Right. Okay, and I guess other people be focused on this Victory Day or in Russia, and see if there's any actions from Putin that comes out of that, and probably that will have a potential effect on the markets as well. Okay, anything else investors should be thinking about, or?
No, I mean, last week was, as you said, fairly eventful. So this is a week to catch up our breath and plot for the future.
Okay, fantastic. Okay, cool. All right, well, good luck, everyone. Thank you, Dominique, as always. And again, as we always say, please reach out to us on Bloomberg or email or even Slack, any questions, things we can improve on, suggestions. And yeah, and good luck.